This is the Future of Finance.
This episode is brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore, Maryland. Hey everyone, welcome to the Future of Finance podcast. I'm Georges Dyer, and really excited about today's show. In the sustainability field, we often say there's no business on a dead planet. Well, in much the same way, there's no successful investing in a collapsing system. That's kind of the basic premise of Bill Burckart's work. Bill is the co-founder and CEO of the Investment Integration Project, or TIIP, which advises institutional investors, including pension plans, asset management firms, foundations, and endowments, on system-level investing. We talk a lot about what exactly system-level investing is and why it's really becoming a strategic imperative for investors and fiduciaries. Bill is also the co-author of the book 21st Century Investing, Redirecting Financial Strategies to Drive Systems Change, and an adjunct professor of international and public affairs and the Brenmeyer Fellow for Impact and Sustainable Investing at Columbia University. We talk about why system-level investing is consistent with fiduciary duty, why modern portfolio theory in many ways is no longer fit for purpose in the 21st century as we face these systemic risks like climate change and extreme inequality. And we talk about some of the examples of investors that are implementing these strategies, including some of the strong financial performance results that they're seeing. Bill is really a visionary, very smart guy. He's done a ton of great work with Monique Aiken and the rest of the team at TIIP. So I hope you enjoy the conversation. Please hit that follow button and subscribe to our YouTube channel if you haven't already, and share this one far and wide. Now, here's my conversation with Bill. Hey, Bill, how you doing?
Doing well, George. Pleasure to be here.
Great to see you. Thanks so much for coming on the podcast. Really excited to talk about your work, and just want to jump right in and talk about the systems level investing concept. So first, tell us what it is. How do you define it?
Yeah, so system level investing, the way that we talk about it, is all about protecting and shaping the systems. Think like climate stability, fair labor markets, democracies that long-term investors ultimately depend on. So it's really about trying to apply less of or complement a idiosyncratic lens with a systemic one.
Mm-hmm. So yeah, it's thinking about, as the name implies, the system.
Yeah.
And how does it differ, or how does it relate to concepts around sustainable investing, responsible investing, ESG investing, impact investing?
Yeah, no, very good question. It's kind of like when Steve Leidenberg and I were writing the book, somebody had said to us, you've got to really show people, it's like the most famous diet book ever, this, not that. So it's like, instead of even eating a hamburger with a bun, like eating burger with like lettuce around it. So this is the eat this, not that part of this. So ESG, as we think about it, right, that's really thinking about company practices. And so how do these external things ultimately influence company value? Impact investing is really about focusing on outcomes of a particular project or a company. So very much focused on that level, where system level investing invites the investor to go further and say, if the system itself breaks, all that diversification that you focus on won't save you. Or put another way, if you're diversified across a failing system, guess what? You still fail. And, when we think about it, one of the first things Steve and I did to kind of help people make sense of that was to come up with a framework to basically say, like, not every issue rises to the system level. So we came up with this. John McCormick and I have now, he likes to use the acronym CRIM, which I clearly don't. But it's basically just saying, is there consensus that the issue is debated globally, that, authoritative bodies are really pointing to these things as having that kind of systemic quality? Is it relevant to the investor's long-term performance, their ability to make good on their mission? Can they effectively do something? And then ultimately, what is the magnitude or uncertainty of these big issues if left unaddressed? And how are they changing so you can ultimately adapt accordingly? And that's really important, that this test that we came up with, because, and you guys, IEN's done a really good work, like with Keith Johnson and others, about kind of this is all through a fiduciary lens. Like, you've got to ground this and make sure that these are widely recognized, that they're financially material, that an investor can influence in them, and that they're potentially catastrophic if they're ignored.
Mm-hmm. So CREM, C-R-E-M is, yeah, because I've been curious about that, like what makes an issue rise? How do you define what rises to that kind of system level consideration?
Yeah, because you want to avoid idiosyncratic or like personal values or political, and in particular in this climate where there's just so much scrutiny, we can't afford to not be precise. And we've
Mhm.
got to be very precise about what we're doing.
Yeah, nice. That's funny. CRIM. It reminds me of cream. Cash rules everything around.
That or the honestly, I don't know why, I just think of like phlegm, like it catches in your throat. So I like your analogy better.
We'll keep working on the branding.
Yeah.
Cool. Well, tell the folks about some of these names that you are throwing out here. So Steve Leidenberg was your co-founder at TIIP, which is the Investment Integration Project, and your co-author of the book you mentioned, 21st Century Investing, Redirecting Financial Strategies to Drive Systems Change. So tell us a little
Yeah,
bit.
we went big with the title.
Yeah, got to get it all in there.
Yeah.
But tell people just basically who Steve is, what TIP is, and yeah, there's the genesis of the book.
Yeah, so Steve is, kind of one of these icons in the responsible investment space. He's been doing this work for about 50 years, has kind of been at the forefront. The the wonderful quality of Steve is that he's always about 5 to 10 years ahead of where the industry is or where the field is. As his business partner, building a business, that can often be challenging. But fortunately, the industry is finally catching up. But yeah, so Steve and I, it's funny how when Tib, the whole gestation of it, I had wrote some piece where I was working with different industry bodies where I was saying, oh, it was about impact investing. And at the time, go back 15 years ago, impact investing, based on how we can measure it, was really output investing. And I wrote a piece about like, well, how do we get more of that outcomes lens into it? And I sent it to Steve to review, and we always exchange writing. And he said, it's fine. He's like, but what you're thinking about is version 2.0 of all of this. And I said, okay. He goes, I'm thinking about 3.0. And I said, well, what's 3.0? He's like, systems. And it just so happened I had been doing a bunch of work in the venture philanthropy space where systems thinking, Danella Meadows, like all of that, I was getting this kind of crash course in all of that. And so when he was like, let's do this thing, let's stand up a white paper and see if it resonates. And people we respected encouraged us to go further. And it's crazy to think that was a decade ago. So I think IEN celebrated your decade last year.
Yep.
And yeah, and so I remember thinking, like, watching how you guys did it, and I thought you did it in such a nice way to kind of cap the decade, and with Tony and all of it, right? Uh, and so we've really been. You think of these big proof points. So after about 5 years of doing the work, in 2021 we published 21st Century Investing, and it was really our attempt to kind of start to help lay the intellectual and theoretical foundation of this field, because this is very much a field where practice has led theory, but you still need theory. That's part of it. And one of the things that we did was really intentional in that we published it. We published ours in April of 2021, and then John Lekomnik and Jim Hawley published Moving Beyond Modern Portfolio Theory in May of 2021. And they were very much meant to be these companion books where tackling the why, what, and the how of system level investing. And so that's where John and I have now gone on to create this course at Columbia University where we teach about system level investing. And I jokingly refer to him as my work husband, because we kind of do a lot of things together now with consulting and whatnot. But it's that thing where a lot of folks that have been grappling, whether from a corporate governance perspective, from a traditional investing perspective, or even from a responsible investment perspective, all kind of coming together to say, like, there's a bigger plot here that we need to figure out as investors. And that's really the manifestation of the work.
Yeah, fantastic. And yeah, John Lekomnik, we're going to have on the show at some point, hopefully soon here, to talk about beyond modern portfolio theory. But speaking of that, I mean, I think that's a lot of what system level investing is, right? Is sort of like, how do we get beyond modern portfolio theory? Tell people just like the basic premise of what modern portfolio theory is and why it's not really necessarily fit for purpose now.
Yeah. So when you think about modern portfolio theory, it essentially assumes you can manage a risk just by spreading investments across companies and industries. It's the diversification, right? And as John will reinforce when you have him on, that works for company specific shocks and issues. But for these big systemic ones like climate disruption or inequality, financial system instability, that goes back to that bigger idea that diversification is not going to protect you. And so if you're thinking about how you steward your capital and how you safeguard your portfolios, you need to think about how you safeguard those systems that are actually underpinning all of that performance, all of your ability to make your mission, all of that. And one of the things that I think moving beyond modern portfolio theory, that book did really well was it highlighted a number of studies that basically said that like 75 to 94% of portfolio return comes from the beta, so market-wide performance, not individual stock picking. So if MPT assumes beta is exogenous and that you can be affected by the market, but you can't affect it, system level investing invites investors to flip that and says, yes, you as investors, not only can you be influenced by these systems, but you can actually influence the systems to drive better beta.
Mm-hmm. Until like kind of just dig into that a little more to give people a sense of what beta is. And I think, it's a good example is like if the market's down 10% and you're a great investor and you're only down 8%, you're outperforming, you're doing better, but you're still down 8%, right? If the market's up 5% and you're a terrible investor and you're underperforming and you're only up 4%, you're still up 4%, right? So just, I mean, it comes back to your great line. If you're diversified across a failing system, you're still going to fail. And so that.
Yeah.
Mm-hmm.
Because ultimately, it's like, even if you're up in a down market, it's still a down market, right? And so the idea is that if you are trying to ultimately safeguard these systems, you're going to be able to drive larger performance for the entire economy. And then that's where it gets into this idea that you're not only doing it from a position of trying to drive greater stability, so you have less of these really severe shocks, but that ultimately it is saying like, look, you as investors right now, you are focused on alpha, right? You're focused on essentially the 25% or less of what's controllable to drive your returns. And so you're leaving all of this other source and or driver of your performance out of your control, out of your focus. And so it's just that bigger question of saying, why? Like, we're all smart people, and a lot of the why is because we were trained to say, well, these are exogenous, and so we can't do anything about it. Right? Again, it's that thing of like, it's not looking at it's not acknowledging the complexity of the world, and it speaks to that kind of broadening divide between capital markets and the real economy. And the moment that you start to acknowledge that connection in a much more clear way, you start to understand why it's so important to try to drive that bigger, better beta.
Yeah.
In alpha.
Yeah. I think it's important to say again, it's just like people think, yeah, okay, markets maybe drive, 80% of my returns or losses, but there's nothing I can do about the market. So all I can do is just the best I can within what the market's doing. And system level investing says, well, maybe there is something investors can do about that broader market.
Well, because it also gets back to, I mean, when you think about like externalities, right? And so if you have so many folks where they used to think like something like pollution is an externality, right? Mm-hmm. But think about where we're at now, where there's nothing really external about wildfires that like shut down entire supply chains or activities around disinformation that destabilize democracies, right? So put another way, like externalities aren't external anymore. They're destabilizers at the very
They've sort of caught up with us, right? It's like, it's the basic premise of sustainability in like a full world. It's like, if we have small populations, we can externalize these costs and we can destroy some nature here, but we'll be able to move on and that nature will come back and stuff. But when we're at the global scale of undermining these systems, there's nowhere else to go. Like, we have to deal with them.
Yeah, there's nowhere to hide. Try as you might, there's just not.
Right. So yeah, these externalities are, catching up to us in such a way that we can't ignore them. And I mean, there's a basic logic to it. It's like, when we think about long-term investors, we're talking about climate, and we have these like minuscule debate, or they seem minuscule. They're not minuscule, but they're important. But it's like, are we going to outperform or underperform over the next 5-10 years? It's like, we can have that debate all day, but if we're in 30 years in a total climate collapse, like, those basis points on your endowment are going to mean very little compared to what's going on around you into your portfolio.
Well, and if you can see these illustrations where it's like, we'll often highlight in our work something like GPIF, the biggest pension plan in the world in Japan. Mm-hmm. And they don't refer to themselves as a long-term investor. They refer to themselves as a super long-term investor, that they have like a 100-year time horizon. The moment that so much of our work is really focused working with institutional investors, and a lot of that, and we find a lot of resonance with pensions in particular because those time horizons are so long. And if you're thinking about, well, how do we make good on our pension promise to beneficiaries? Well, that's huge, right? Like that's a huge point where it's to say your university pension plan and you're saying, well, we know we have to manage the climate in order to make good on that promise to our beneficiaries. And making that connection, I think, gets into a lot of the work that IEN's been doing with Keith Johnson and others, where it's to say, look, this is fiduciary aligned because, yet again, when we say systemic risks, we're talking about intergenerational risks. And the moment you introduce that connection, the moment you get into the duty of impartiality, you can't preference today's beneficiaries over tomorrow's. And you start to understand like what we're talking about is like fundamentally, how do we manage complexity, particularly complexity that's going to continue to evolve over the long term?
Mm-hmm. Yeah, exactly. And you mentioned Keith Johnson a couple of times. I just want to let people know who he is. Lawyer, former general counsel, the Wisconsin Retirement Plan, member of our board, and he's going to be giving a keynote at our annual forum coming up in late October. And we'll probably have him on the show soon too to talk about all this.
He and Tiffany Reeves she's another leading legal mind on all of this. And I will say that they have done some of the hard work to really help to articulate this connection and this gets, and we don't need to go into it, but just to say, like, so many people are like, oh, what is this? And we need to change requirements around fiduciary duty. And it's like, no, these are just dimensions of fiduciary duty that have just gone kind of like people have silenced them or just not focused on them a lot, all in this pursuit of short-term returns and shareholder primacy and all that. But the reality is these requirements are on the books. Like it is something, and institutional investors in particular really need to be mindful of.
Yeah. And I think it's understanding, where we mentioned about systems thinking and being able to see this whole system to then apply the existing fiduciary laws and guidance to that reality. Yeah. Nice. Well, let's talk a little bit about how investors actually put this into practice, because this is the area that I think, in my view, seems to still be evolving, maturing, getting sorted out. And I feel like there's some really practical things that can be done, and then some things that still feel like, what do we actually do? What can we do in the face of this? So we just give like a little bit of an outline about what investors do to put this into practice.
Yeah. So there's a couple of things investors do, right? So there's essentially this like 3-part toolbox. And this was something that when Steve and I were first starting to kick around a lot of these ideas, we would have these big roundtables with lots of different investors. And goes back to one of your first questions about like, okay, well, what distinguishes a systems focus from, ESG integration or impact investing? And so part of this is like saying, okay, there's this 3-part toolkit. One is what we broadly call investment enhancement. And investment enhancement is really adapting those kind of core tools or mechanics of investing so that they are also strengthening systems, not just portfolios. And so one of the examples I mentioned was University Pension Plan of Ontario. So we had worked, TIIP and Sinclair Capital, John's group, we worked with them to update their investment beliefs so that it really called attention to their responsibility to essentially manage system health. Or you have PGGM that takes this 3D investing approach, which they're using security selection and portfolio construction to align with the SDGs and other system level considerations. You have the investor, I'm sure you've had somebody on here talking about like Vale, the dam disaster, where investors put a global standard for tailing safety across the mining industry. Think about manager selection. So you're seeing this more and more where PGGM firing BlackRock and Elgin, or the People's Pension pulling 28 billion pounds from State Street because of weak climate stewardship. And then all these other examples, like what is it, the Cambridge Bloomberg Index that's now essentially, excluding fossil fuel expansion projects. And so those are those kind of like, it's the bread and butter of what investors do, but now we're thinking about, well, how do you elevate that to that system level consideration? Mm-hmm. And then the other 2 big buckets that we talk about are field building. So this is kind of pooling resources to create shared industry capacity. So anything from coalitions, like IEN obviously has run a number of these types of things, but you can see that also in something like Climate Action 100 Plus or Council of Institutional Investors. It's these ability to say, look, investors by how we're trained, we're inherently competitive. And so it's like, but how do you, in acknowledgement that these big systemic issues, not one investor can solve them on their own. So how do you start to get people collaborating more intentionally and concretely? There's things like policy engagement. It's another area that I know you guys have focused on, where it's like the UK Stewardship Code requiring investors to actually like address systemic risks, or think about the data infrastructure. If we don't have the data that can help model out, okay, why should we be handling or tackling something like inequality? Or, how would you start to model out something like human rights, right? If we don't have the quantitative data or just the understanding of how to do it, that's a huge gap. And so it's like, a lot of investors will try to fill that gap. And then the last part is around opportunity generation. And so this is really this acknowledgement to say that like some of this doesn't sit on a shelf somewhere. So you have to design new products and services and innovations that ultimately can do this. So you see a number of different pensions where they're doing emerging manager programs, or thinking about additionality, like in microfinance or community credit unions, or like locality, CDPQ. So they do a lot of stuff to stimulate local jobs and resilience. So it's all, and green bonds, where it's like something where you're evaluating the inherent worth of some of these systems. And so what we're ultimately trying to show people is that if you think about these in this kind of like at a high level, where it's like field building essentially helps change how investors collaborate, investment enhancement changes how they invest, and then opportunity generation changes what they're investing in. And so all of that can be essentially retooled or tooled to strengthen the systems that markets ultimately depend on.
Mm-hmm. Gotcha. I'm curious on the policy piece. The example you mentioned there was around, how policies can help drive investors to do this better and consider the systemic risks and the like. But do you see a role for investors on just like directly engaging on policy that will address some of these systemic risks? So like climate change, for example, going and working with policymakers to say, you need to put a price on carbon. You need to do some major policies to address this, because otherwise it's going to crush the value of our portfolio.
Yeah. And I would say that, we're on a current client engagement right now where it's the policy part, where it's one of the key kind of tools in the toolbox for all of this. And we're hearing from different regulators who are like, we want more input from institutional investors. They go out and call for, feedback and whatnot, and investors aren't always showing up. And so I think that there's that part where we talk about it a lot, but like we actually have to show up and inform this stuff. And I will say that on this particular client engagement, where what we're, thinking about, like if you're taking a systems strategy, different jurisdictions right now, like take like the EU, UK, and US, and you have something where it's like in the US, it's like openly hostile to this kind of thinking. The EU, where you have this kind of like, 2 steps forward, 1 step back. And then the UK, which is kind of staying the course with slight modifications. But for any institutional investor right now, like it is reinforcing how important the policy piece is, but also just how challenging. Because even in the US, it's like, are we talking about Texas? Or are we talking about California? And like, and so but I would say the overarching headline here is to say, yes, it is a huge lever that more investors need to start to exercise, because, some things, it's like, look at what the industry has achieved largely on voluntary standards. There is a case to be made that mandatory standards really help set a floor that investors really should be starting from as they do this work.
Yeah. Do you think it's the kind of lack of policy engagement is just they're too busy, they don't have the resources, or they just feel uncomfortable with it, they don't see it as part of their job, or don't understand the issues well enough, or would
a combination
of those things?
I think it's a little bit, unfortunately, it's a little bit of all of that.
Yeah.
It's you're raising your head in an environment right now that is,
well, sure. Yeah. Right now, everything's a little different, but yeah, I mean, it's been that way for a long time. And I've always read, like, that all makes sense. I'm like, yeah, it'd be tough to, you're an investment analyst or something, or a CIO, you can take the time to go down to Washington and meet with some, regulators about some, climate policy, which isn't necessarily even directly related to investing. But I think about, it's so funny, it always reminds me of Liar's Poker when they went down and sort of like created the securitized mortgage market. It's sort of like investors can go influence policy when they want to, you know?
Yeah. They'd have it any good way. Hey,
Right.
they find a way. Well, the other thing too, I mean, this is just like more of a, I guess, a general statement on when we think about policy and we think about investor engagement, that oftentimes, the people that are showing up for policy days on the Hill and things like that,
Mhm.
they, you need more of the folks that are managing the real engine of these institutions. So you need more CIOs showing up for things like that because it has a different level of weight than if they're always hearing from the CSOs or others that it, because there is still, we will always as an industry, I think, be grappling with questions about authenticity and, do we, whether it's fair or not, I think we promised a lot as an industry, but we didn't necessarily make good on the promise in the way that has left us a little bit vulnerable to certain attacks. And so I think the more that we can really get folks in the room that can speak to this in a way that takes any, and that's part of the whole value of a systems perspective, is because you're grounding it in this real kind of justification and credibility that allows you to talk about these issues in a way that is, I think, more resonant and other than just like, well, this is how I think the change should be in the world. And I think these things are bad and these things are good. It's like, well, let me back it up with all of like the rigor.
This is scientific reality. Here's the data. This is our fiduciary duty. This is in our interest to do it.
Yeah.
And who do you see driving it when it works best? Do you work with investment teams? Is it investment committee members or trustees that sort of set the policy that say we really need to take this system level approach?
Yeah, it's a good question. So I think where we found it most effective is when you have trustee buy-in, where they're basically setting the beliefs and the direction, and that you have CalSTRS is a group that we've worked with a lot. CalSTRS will often talk about like, and this is true of many institutional investors, where they have to take a total portfolio approach. So they have to consider everything across all asset classes, across governance, policies, programs, practices. And so the ones that are doing that well, they have that board level buy-in. So they have even not just general board, but like the investment committee is blessing this and they're helping to promote it all the way down to, so if you have the trustees kind of setting that strategic direction, those beliefs, then you go down into the investment teams, the stewardship teams, and you have that kind of like they're executing the practice day to day. So I think for most institutions, the biggest like takeaway is like you kind of have to you have to do this kind of dual alignment. You have to be bought in at that strategic level, at that governance level. And then the folks that are expected to execute on this, day to day, they really have to understand it. And I know from like working with a number of different investors, particularly pensions, where you have different asset class teams and these ideas and this thinking and this rigor and all of that, it lands differently. And so there's very rare that you have an institute like a university pension plan where they were just everybody's like, here's our North Star and we were just driving towards it. Right.
Yeah. We're having Brian Min on actually. I recorded an episode with him already.
Oh, fantastic.
Yeah.
Yeah.
So we'll get to go deeper on that example. Yeah, that makes sense. I mean, I think we see that dynamic in any sort of form of this sort of mission aligned responsible investing. So you've mentioned a bunch of examples, University Pension Plan, CalSTRS, any others that you want to just definitely highlight that have like done this particularly well or leading on it?
Yeah. So, I mean, I think you can look at, particularly with Climate Week coming up, there's a number of groups like, I mentioned PGN, but like Westpath, they've done under the sustainable economy framework, they've done a lot of work where it's looking at not just like the low carbon transition, but really thinking holistically about how they apply this lens across everything they do. And including, they've been really out in front, like being part of Net Zero Asset Owner Alliance and others, where they've really brought to the forefront that real importance of manager engagement, that when you think about stewardship, when you think about engagement going forward, you have to move beyond just a company by company to really consider, okay, are we engaging our managers, our entire value chain? Are we also engaging policy? And So that, I think that's an exemplary illustration. You have others where it's like in the foundation world. One of the groups that we just did a project with is Rockefeller Brothers Fund. And it was really looking at how since 2014, they essentially aligned their endowment, a $1.3 billion endowment, with its mission. And when you look at what they did, it was not just about mobilizing their investments in a certain way, but it was also about, okay, how do they bring their, outsourced chief investment officer, so Cerity Partners is their OCIO. How did they explore that with their OCIO, doing that in partnership so that they could all get smart, that they all could learn? And how did they think about not just one systemic risk like climate, but also things around gender and equality? And so when you think about all of those like different dimensions coming together, they can show like, yeah, the results are there. Like if you do this, that you're not facing a trade-off. Like some of the high level data points, they were something like they have a 7.76% annualized return. So they outperformed the benchmark by over like 100 basis points. 99.7% fossil fuel free portfolio, nearly 23% in impact investments, and over a quarter of their assets and managers owned by women and people of color. And so when you think about all this, like it helps to reinforce that not only can you do these really interesting things that help you better manage through complexity, because that's ultimately what we're talking about, but how do you do that in a way where you're not having to deal with trade-offs necessarily?
Yeah. That's always so important to have those financial performance examples just to show that, this can be done. You can have all the data and sort of academic studies, but just every example, they're beating the benchmark by 100 basis points, like you say, they're meeting their spend targets and keeping up with inflation, like meeting their targets. And that's what they need to do. And they're putting it into practice. Yeah.
And I think in an age like now where with all this heightened scrutiny, you have to think about the durability of what you're doing. And that's part of the way you show that durability. It's like, we are doing this through a fiduciary lens. We are driving real results. And importantly, they're being super transparent about it. And I think that the, sunshine is the best disinfectant, right? And so it's like I think more investors need to be able to do that, to kind of follow examples like that. I mean, UPP, same thing, learning in public, right?
Yeah.
CalSTRS, same thing. Like these are good examples that I think more and more investors can start to emulate. And then it gets into that, well, yeah, now we can start to change awareness and activity, hopefully for other investors too.
Totally. We'll put a link to that report you guys did on the Rockefeller Brothers Fund in the show notes because it's a good one. And also, another component of system level investing, they've been really active in the Intentional Endowments Network and supportive in being that case study. I remember they did a 5-year update 5 years ago. Yep. And that's really valuable stuff. Nice. This episode is made possible by Metis Global Partners, a global equity solutions provider managing over $5 billion. Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients, including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's metisgp.com, or email info@metisgp.com. The Intentional Endowments Network's 2025 annual forum will take place on October 27th and 28th at Goucher College in Baltimore. This forum will convene 100 to 150 endowment, foundation, and sustainable investing industry leaders to discuss how to maintain intentional investing momentum at your institution, covering topics including system-level investing, the fiduciary duty case for sustainable investing, strong democracies and political risk, climate risk and opportunity, responsible technology and artificial intelligence, inequality as an investment risk, and taking an expansive approach to talent. The program will be designed for endowment and foundation trustees, chief investment officers, and investment teams, as well as practitioners from investment consulting, outsourced CIO, and asset management firms. IEN events are intentionally designed to be highly interactive with plenty of time dedicated to dialogue at roundtables and networking, in addition to excellent presentations from experts and peer institutions. Go to intentionalendowments.org and click on Annual Forum to learn more. So what do you think to sort of really get systems level investing to take off? Do you think it's primarily just educating fiduciaries and investment teams now? Do you think, are you working, well, you mentioned the class at Columbia that you are involved with teaching. Do you feel like getting embedded in business schools is a key part of the strategy? Or is it that fiduciary duty case? Like, where do you see the levers?
Yeah. So it's funny, and you should ask John about this, because I asked him recently, because, John helped essentially build the corporate governance field of practice, right?
Yeah.
And I had asked him at one point, just in, this work it's a lot. And I said, we're 10 years in, I want to be reflective about where we place our bets going forward. And I said, what should we be doing? Like, we're continuing to build the evidence base. We're now building out the ability to kind of get educated on this and get trained on it. And one of our big things for TIIP was, in particular, and this was something that we saw Thinking Ahead Institute did this interesting study where they were looking at, like, what are asset owners saying they need to be able to really move the needle. And one of them, a couple of the findings were just like, it's like over 80% of them are like, we've got to figure out better ways to grapple with managing complexity. And many of them pointed to this like correlation with, we think AI is going to be one of the ways that helps us do it. And so for us, we built a whole platform to essentially do that, to help investors better manage this across their policies, programs, and practices. And I think when you think about, with the education stuff, it's not just that we're establishing this curriculum at Columbia. I'm involved in it's called the Impact Investing and Sustainable Finance Faculty Consortium. It's run out of Chicago, Kellogg. And we socialize all of our syllabi, our case studies, all of that. So it's really helping to inform how other professors are also starting to teach on this and train on it. And I think when you think about, like, whether it's just continuing to build the evidence base, these real use cases, it's building the kind of tech infrastructure for people to be able to do this. And then ultimately, eventually it would be great if there was like a CFA certification on this or something like that, right? But I think you have to do all of those. And then you have to make sure that you're shining bright lights on, like, Jim Hawley has launched this Aaron initiative, which is really trying to how do we think about externalities? How do we begin to really model those? And it's those kinds of examples where and what Keith Johnson's been doing and Tiffany Reeves about fiduciary duty. It's like, we've got to continue to shine lights on those really interesting bright spots, because it's going to take a constellation of us continuing to reinforce this. And I will say, this is something that came up this was our recalibrating feedback loops paper, where we basically, one of the things we were talking about, well, how do you begin to evaluate progress at this level? And Emily Goodall, who she used to run stewardship at Fidelity International in Europe, and she was saying how, one of the things that a big aha, and this is like almost like a task for you guys at IEN, it's basically like, this reinforces the role of the kind of investor networks and associations, whereas to say, if collective mobilization is a huge aspect of this, and right now individual investors are getting dinged in certain ways and whatnot, like, we need the networks, we need the associations to help bring all of this in a much more intentional and coordinated fashion to raise the bar. So I think it's all of us, unfortunately, like, we all have to be doing it.
Yeah. No, absolutely. And I think, it's great. It's great to see the community of practice too. And it's been fun I just feel like even in the last 6 months, 18 months, I have seen it bubbling up more and more, and like all these folks on podcasts and getting out there talking about it, and more investors. I think it's just, the work that you and others have done. There's more investors that have done it. There's more case studies. There's more traction. And tell us a little bit, I think you kind of alluded to it, but tell us about the sale tool too, because that's like a piece of the technical infrastructure, right, that can help investors do this.
Yeah. So what we kept hearing, we did an industry needs assessment, and right after we published the book, a lot of our key stakeholders were like, well, and it gets to your question, right? Like, how are we going to move from awareness to action in terms of really getting the investment community, not just getting adoption by investors, but driving bigger industry transformation? And what came through, there was like the need for, exactly to your point, a need for a community of practice to share best practices, to learn from each other, all of that. Clarity around fiduciary duty was another piece. And we need to think better about how we measure But the thing that we really zoned in on was just this idea that people needed a turnkey solution. They needed something that, in the face of this magnitude of information and understanding that they now need to somehow make sense of, and to do it in the context of a total portfolio approach, they needed something. They needed an institutional quality tool. And that was what we set out to do with Sail. And Sail really, there's a couple key components to it. One is around self-assessment and building your strategy when it comes to integrating a systems approach. So it helps you essentially develop that across all of your policies, programs, and practices. Then it helps benchmark who's doing what, and actually running evaluations on it. We did this for a couple of the folks that have subscribed to it, where it's say like, we're going into meetings so with managers, love to get a sense of, from a systems perspective, how are they doing? What are they doing? What's the quality of that work? And you can run these things really quickly. And so it's like that, and then that reporting question. So if you think about it from a strategy, benchmarking, and reporting, that's really what Sail helps to do. So like what used to literally, and I know because we did this work as consultants, where what used to take months to do, you can now literally do in the matter of a few minutes or an hour. Like that's the kind of quality of what it's getting to. And I think that's what will invite more investors to be able to do it. And obviously it's not just TIIP and it's not just Sail. There's plenty of other efforts that are also helping to move the needle here, but that's where we've placed our bet. And obviously I hope it's the right bet.
And is it just kind of really designed for asset owners, or is it have applications for managers?
No, it's what we've discovered. We've made a couple of happy discoveries as we built this system. So one, we've designed in a way where it helps to customize depending on the kind of investor you are. So, there's going to be certain dimensions that are more relevant to an asset owner, a particular type of asset owner, than an asset manager or an investment consultant. But the platform helps to customize that. So any kind of investor can do it, because what we kept finding was asset owners are like, I want to be able to essentially reflect a systems perspective out to the industry in terms of what we're doing and our expectations. And then it was like, and we want to be able to evaluate asset managers along those lines. Asset managers were then coming to us and saying, well, we're being evaluated along these lines, but we don't actually know what any of this means. And so that was okay, let's build it for both. Then what we realized is that as we were going through it, there's new things. And this is stuff that'll be more, you'll start to see more of this in the platform over the coming months, where it's like, we can actually run portfolio company analysis using the system as well. So you can start to see how you can connect the value chain. And we think that that's really important. And which I haven't actually done Intentional Endowments Network yet, but we can actually do evaluations on industry initiatives to basically say, okay, which of these groups is really providing education, training, facilitation around systems thinking, or new research or anything like that. So it's really it can be used by any kind of investor. And then one of the things that we did this for outsourced chief investment officers, or investment consultants generally, where you can literally, like, if you have multiple clients that you're trying to bring through this process, you can essentially be invited into each of those clients' like dashboards and help to guide them through that process. And then what we realized was that not only was that functionality something investment consultants were asking for, but it was something that major asset owners that have essentially brought most of their management internally, that they need to be able to essentially have these different dashboards for different teams. And so now we're using it in that way too. So we know we're just scratching the surface of what this thing can do, but it's pretty exciting. And I think it will help to create that kind of shared baseline of understanding and vocabulary for how this, and we're hoping this will more and more, like, because you can build your profile and then it can immediately do your PRI reporting for you, or it can do, you go down the list. And so it's like, yeah, we want to see more of that language get out there, and hopefully investors back it up too.
Nice. And so how do people use this? Is it just for your consulting clients, or is there like a licensing model, or how do people get access to it?
So it's subscription based. And so people can do it, we've had anywhere from institutions that are subscribing directly to those that are like, I'm subscribing, but because we have these like different packages, but it's like different user slots where you can actually subscribe, but maybe you want to give one of those user slots, if you're an asset owner, to 3 of your most, advanced managers that are interested in getting smarter about this. And so we do those kinds of things as well. But yeah, it's one of those things where it's like, figuring out, trying to meet the market where it is and realizing like not everybody is CalSTRS, not everybody's university pension plan, not every, right? But figuring out like, how do we meet you where you are so you can start to move in this direction?
Yeah.
That's what we're trying to enable.
Very cool. Nice. Yeah. Well, Bill, this has been awesome. I want to move on to some of our final questions, but before we do, anything we didn't cover that you want to make sure we talk about?
No, I mean, I think that I think the big headline here is that when you think about system level investing, and what's the big idea, it's that we're not system level investing. Whereas if you think about investing in the past or even ESG integration and whatnot, that it was all about just managing exposure. And I think that the key idea that I want to get across with system level investing is that you're trying to actually reshape exposure itself. And I think that that's for any investor that's like sitting on the sidelines trying to make sense of this, just remember that. That's the key idea that I think I want to leave people with.
Yeah, I think it's a perfect way to put it. Nice. Well, we're going to run through our quick take questions here.
Okay.
So what's one thing you wish every institutional asset owner would do tomorrow?
I want them to adopt or update their investment beliefs to explicitly recognize systemic risk.
I love it. That's where it all starts. How about a resource, a book, podcast, article that you think people should check out?
If you have a couple of dollars to spend, I would say 21st Century Investing and Moving Beyond Modern Portfolio Theory. That really is the intellectual foundation of all this. In addition, if you don't have any dollars to spend, you can go on to Chief Investment Officer. It's a media outlet for institutional investors. I did a 3-part series where I really tackle the why, the what, and the how of system level investing. And it really helps to provide a little bit of a blueprint for people. So I would highly recommend checking those out.
I would too. That article series is great. And I actually just kind of like peeked back at it as we were preparing for this, and it's fantastic. So people should definitely check that out. All right, what would we most likely find you doing outside of work?
So water is kind of the consistent theme. So I split my time between New York City, where I teach, and South Florida, where I was born and raised. And so I am often either doing endless laps in a pool or learning how to become a better kiteboarder. So those are some of my free time activities.
Nice. That's awesome. So I come up with all these questions in the outline for the thing, but I sometimes throw it to AI for some suggestions, and it came back with, you're learning Spanish and amateur kiteboarding, which is more challenging. And I was like, is that true? And how does it know?
Yeah, no, it's actually true. I think that, that was because of it was a profile that some outlet did. So I would say the shared characteristic of both is that they're both humbling. I would say that the difference is that only one of them will throw you around the water when you get it wrong. And that is so...
A little more physical risk with one, yeah.
There's definitely a more physical risk, yes. Embarrassment with one, but definitely physical risk with the other.
Nice. All right, and our final 2 questions we ask everyone. What's your vision for the future of finance?
So I want a financial system where markets really reward investors for stabilizing the systems that we all rely on to create long-term value. I mean, that in a nutshell is what I would like to see happen.
Yeah. I feel like that question was designed for you. I was.
That's an easy one. I thought you're giving me some softballs here.
Yeah. And how about advice you'd give to college students or young people interested in getting into this field?
Yeah. So John and I, first class of every semester, we have this slide where he shows that his starting point was corporate governance and my starting point was impact investing, but we both ended up at systems. And I would say that anybody that's looking to get in this industry, that get the basics of portfolio management, but also learn systems thinking. I think a fluency in both is going to just make you so competitive and, importantly, way more effective, particularly as these big issues just become more and more present, greater magnitude, and things that we have to truly deal with sooner rather than later.
Yeah, awesome. No, it's great. The systems thinking piece is a lot of where I came to this work from. And I love that Dana Meadows has come up in probably 80-90% of the conversations we've had on this podcast. So if people are not familiar with her work, should check it out. And John Sturman and a lot of folks at MIT, and lots of resources out there. But it's I think it's central to so much of this for people to understand systems. So thank you for the work you're doing and bringing it all to light in such a practical way. And thanks for taking the time to come on today.
Thanks for the opportunity to be here. This was fun.
You bet. This episode has been brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.